All right. So you're here because you're interested in like how market trends sometimes
Yeah.
feel like they're driven by these like self-fulfilling prophecies.
Exactly. Yeah.
So this paper, Self-referential Behavior, Overreaction, and Conventions in Financial Markets, we're going to kind of dive into that. Gets into like all the nitty-gritty of that.
Yeah, it really digs deep into how that sentiment can sometimes drive the trends themselves.
Right. And it's not always based on like real information.
Yeah.
That's the thing.
That's the fascinating part.
Okay, so you know the efficient market hypothesis, right?
Yeah.
Like the idea that stock prices are always reflecting
All available information.
yeah, all the information that's out there. So
Yeah.
in theory, any price changes should be like totally random.
Random and unpredictable.
Yeah, driven by like news and stuff.
Right.
Okay, so that's the theory. But is that always true in practice?
Well, that's the thing. The sheer volume of information that could affect a stock's value is enormous.
Right.
Even for experts.
Yeah.
Trying to process and predict the impact of all those variables
Yeah.
is a challenge.
It's like trying to predict the weather
Right.
with like thousands of factors
Well,
changing all the time. It's just not realistic.
Not at all. And that's where things get interesting. If perfectly rational decision-making isn't always possible, what
Right.
fills the gap?
Yeah.
That's where self-referential behavior comes in.
Okay.
Have you ever heard of Keen's beauty contest analogy?
I think so, but refresh my memory.
Okay, so imagine a game where everyone has to guess a number closest to half the average guess.
Okay.
Logically, the best answer is 0.
Right. But if you assume everyone else is going to be like a little irrational,
At least a little.
then 0's not the best answer anymore.
Exactly. You start trying to outsmart the crowd,
Right.
and that pushes the optimal guess higher and higher.
Higher and higher. Yeah.
And what's fascinating is that this is exactly what happens in markets.
Oh, wow.
Traders often find themselves trying to predict
A market's opinion.
Yeah.
Rather than focusing on a stock's intrinsic value.
So it's not about being right. It's about
Yeah.
predicting what everyone else thinks is right.
It's about being right about what other people think.
That's kind of scary when you think about it.
Yeah.
What happens when everyone starts thinking that way?
That's where conventions form.
Okay.
These are basically shared beliefs about market behavior, often formed with limited information.
Okay.
For example, there's a historical idea that stock markets always decline before wars.
Right.
Now,
I can see how that might have been true in the past,
Yeah.
but does that still hold up today?
that's a good question.
Yeah.
And is it a real connection or just a self-fulfilling prophecy?
Right.
That's the key question.
Yeah.
The belief itself can become strong enough to influence market behavior regardless of the actual connection. But these conventions are not set in stone. They can change sometimes quite abruptly.
Oh, wow.
Yeah.
Do you have any examples of that happening where...
A widely held belief about the market suddenly just like flipped.
Well, consider the relationship between bond and stock markets. For a long time, there was a strong belief that falling interest rates benefited both asset classes.
Right.
So they tended to move together, a positive correlation.
Because lower interest rates make it cheaper to borrow money.
Right.
Which can fuel economic growth and boost both stocks and bonds.
Exactly.
What's interesting is that this isn't always the case.
You're right. Beginning in the late 1990s, we saw a shift. Now, when the stock market drops, there's often a flight to quality.
Okay.
Investors sell stocks which are perceived as risky and buy bonds which are seen as safer.
So the correlation flipped. They start moving in opposite directions.
Yeah.
I'm curious, like, what caused such a rapid change
Yeah.
in market behavior?
It was a series of extreme market events that really shook investor confidence.
Yeah.
These events challenged the long-held belief about the relationship between bonds and stocks,
Right.
making people reconsider what safety really means in the market. What seems like a solid rule can disappear practically overnight.
Wow.
Yeah.
So how do we even begin to model this kind of unpredictable, sentiment-driven market behavior?
Yeah.
Can you really capture that mathematically?
The paper uses what's called a feedback loop to represent how trader behavior can influence correlations. Think of it like a microphone and speaker system.
Good.
The initial signal, whether it's news or just a price movement, gets amplified through the feedback, potentially creating a much louder sound than the original input.
Oh, I see the analogy. The microphone picks up a small sound and amplifies it through the speakers.
Exactly.
Creates a larger sound that then feeds back into the microphone,
Right.
getting amplified even further.
Exactly.
It's a cycle that can build on itself.
Exactly.
But how does this apply to financial markets specifically?
There are 3 key components in this model. An indicator like interest rates or even past price changes,
Okay.
the asset's price itself, and a coefficient that measures the strength of the relationship between them. What the model shows is that if enough traders believe in a particular correlation,
Right.
even if it's not based on strong fundamentals, their actions can actually make it a reality.
So it's not just that the market is inherently trending or mean reverting in some fundamental way.
Right, yeah.
It's that the shared belief in those patterns, amplified by everyone's actions,
Exactly.
can actually create those patterns.
Yes.
That's amazing. And this is what the paper refers to as
Self-referential behavior.
right, self-referential behavior.
Exactly.
Okay, and this model then applies that concept to specific trader behaviors like trend following and contrarian strategies.
Exactly.
Okay, so trend followers, they jump on the bandwagon when they see prices moving in a certain direction, hoping to ride the wave.
Right.
Contrarians, on the other hand, they go against the crowd,
Yeah.
betting that things will eventually revert to the mean. But how do these strategies connect to the idea of conventions we were talking about?
Well, if enough traders believe in a trend-following strategy, for instance,
Okay.
you get what's called positive autocorrelation.
Mm-hmm.
Prices going up today make them more likely to go up tomorrow, at least in the minds of those traders. Conversely, a dominant contrarian sentiment leads to negative autocorrelation.
So it's like those financial news segments where they're debating whether the market is overbought or due for a correction.
Exactly.
Those narratives are basically reflecting the dominant convention at play, right?
Exactly. And these conventions driven by self-referential behavior have a significant impact on market volatility.
Volatility meaning the size of price swings?
The degree of price fluctuation.
So you're saying these beliefs can actually make the market more or less volatile?
Precisely.
Yeah.
Think of it like driving a car. Trend following is like slamming on the gas pedal.
Okay.
Amplifying any movement. Contrarian behavior is more like tapping the brakes, smoothing things out.
Right.
So a market dominated by trend followers is going to be much wilder than one dominated by contrarians.
So how do we know which convention is in play at any given time?
Right, yeah.
And how long do these conventions last?
Yeah.
Are we talking days, weeks, or even years?
That's a great question.
To really see this in action, let's talk about what the paper found when analyzing a whole century's worth of data from the Dow Jones Industrial Average.
Okay.
Did they find evidence of these shifting conventions in the real world?
They absolutely did. The analysis revealed extended periods where the market exhibited either trend following or contrarian behavior, sometimes lasting for decades.
Decades.
Yeah.
Wow. I had no idea that these sentiment-driven trends could persist for so long.
It's fascinating, isn't it? And what's even more interesting is that the Dow Jones data showed a clear bias towards trend following, especially between the 1950s and the 1980s.
Oh, wow.
Of course, there were periods of contrarian dominance as well, notably after the 1929 crash.
That makes sense after experiencing such a dramatic market crash.
Right.
I can see why investors would be wary of chasing trends and become more contrarian in their approach.
Exactly.
But what about those longer stretches of trend-following behavior?
Yeah.
What could explain that?
Well, remember how we were talking about information sometimes being slowly incorporated into prices?
Right.
Things like limited liquidity and large order sizes can actually create some degree of positive autocorrelation.
Yeah.
Giving trend following a real basis to take hold.
So it's not just a purely psychological phenomenon.
Right.
There can be structural reasons why trends emerge in the market.
Yeah.
And those trends can then be amplified by investors piling on.
Exactly. And on the psychological side, trend following is simply a more intuitive strategy for many people.
Right.
It's easier to see a rising price and jump on board than it is to try to anticipate a reversal. That natural inclination towards trend following can then become a self-fulfilling prophecy, driving prices even higher.
It's like a feedback loop.
Yeah.
Where the trend reinforces the belief, which then reinforces the trend.
Exactly.
It makes you wonder how these conventions ever change, if they can last for decades.
Right.
What causes those shifts?
Sometimes the shifts are gradual. Maybe the number of traders using these self-referential strategies slowly increases or decreases, causing the market to gradually tilt one way or the other.
Okay.
But other times, as we saw after the 1929 crash, the change is abrupt.
Right.
Likely triggered by a major event that injects a lot of uncertainty into the market, forcing people to reevaluate their assumptions.
It makes me think about those periods of extreme market volatility.
Yeah.
Like crashes or sudden surges.
Right.
Are those just examples of these conventions being taken to their extremes?
That's a really insightful observation. Think about what happens during a panic.
Right.
Everyone is looking for any signal they can find, and that short-term focus can actually intensify trend-following behavior.
Yeah.
So everyone becomes hyper-aware of what everyone else is doing, and that creates a feedback loop on overdrive.
So the market essentially spirals out of control, driven by shared fear that is amplified by everyone's actions.
Yeah.
It's fascinating how these psychological dynamics can have such a profound impact on prices.
And then just as suddenly the convention can flip, perhaps a few contrarians start to see value amidst the chaos. Or maybe it's just random chance that breaks the trend.
Right.
Whatever the cause, the volatility drops, uncertainty decreases, and the market eventually calms down.
Okay.
And then, of course, the whole cycle can start all over again.
It really highlights how unpredictable the market can be, even though there are these underlying patterns driven by human behavior.
Right.
Now, we've been talking a lot about overall market trends,
Yeah.
but I'm curious about how these self-referential dynamics play out at the level of individual stocks.
Right.
Does the paper address that?
It does. The paper also looked at what are called cross-correlations between stocks in the S&P 500,
Yeah.
and they found further evidence of these shifting conventions.
Okay, I'm intrigued. What exactly were they looking at with these cross-correlations?
They were analyzing how the correlations between pairs of stocks or between a stock and the overall index fluctuated over time. And to make sure they were seeing something meaningful, they compared those real-world fluctuations to what you would expect if stock prices were truly random and there were no serial correlations at all.
So they essentially created a control group
Right.
to see if the actual market data was behaving differently than pure chance would suggest.
Exactly. And what they found was quite interesting. The real-world correlations between stocks were far more dynamic than you would expect by chance.
Interesting.
There were periods where stocks moved much more in sync with each other, followed by periods where they seemed to go their separate ways.
So it's like the entire market was suddenly deciding to move together.
Yeah.
And then just as suddenly everyone went their separate ways.
Exactly.
What could explain that?
It's difficult to say for certain without a more detailed analysis, but one possibility is something called sector rotation. Imagine investors shifting their focus from, say, technology stocks to energy stocks. That could create a temporary increase in correlation within those sectors as investors pile in or out while simultaneously decreasing the correlation between them.
So it might not be that the individual companies are becoming more or less fundamentally linked,
Right.
but rather that investor behavior, driven by these conventions, is creating the appearance of those shifting correlations.
Right. And remember, even though we're talking about correlations between stock prices, it's still that same underlying principle of self-referential behavior that we've been discussing.
It all comes back to that idea that investors aren't always reacting to objective information.
Right?
They're also trying to anticipate each other's moves, creating these feedback loops that can amplify even the slightest hint of a pattern.
You got it. It's like a giant game of telephone where the message gets distorted with each retelling
Right.
until it's barely recognizable from the original.
Yeah.
And this makes you wonder if these self-fulfilling prophecies are so powerful, can we ever really tell what's truly driving the market? Is it real information or just a bunch of shared delusions?
That's the million-dollar question, isn't it? And it's one that this whole discussion of self-referential behavior really forces us to confront. It feels like we're going down like a rabbit hole here. If markets are so susceptible to these like self-generated narratives, how do we as investors separate the signal from the noise?
It's a fundamental challenge for sure, and it really highlights the limitations of that efficient market hypothesis we talked about earlier.
Right.
In a world where prices can be so strongly influenced by these self-fulfilling prophecies, the idea that they always perfectly reflect underlying value starts to break down.
Okay, so if we can't rely on the market to be perfectly rational, what's the alternative?
Right.
How do we make sense of all this and maybe use it to our advantage?
Well, it's important to remember that the efficient market hypothesis isn't entirely wrong.
Okay.
There's still a range of prices within which arbitrage can operate, keeping things somewhat anchored to reality.
So it's not like a black and white situation, either completely efficient or total chaos.
Right.
There's like a gray area in between.
Exactly. The market can get caught up in these self-referential dynamics without completely losing touch with the fundamentals.
That makes sense, but like, how wide is this band of rationality?
Right.
At what point do those self-fulfilling prophecies push prices too far?
That's where it gets tricky. the paper suggests that as long as the price stays within, say, a factor of 2 or 3 of the true value, those self-referential effects can dominate.
A factor of 2 or 3?
Yeah.
It's a pretty wide range.
It is, and it reflects how difficult it is to pinpoint a stock's true value.
Right.
Think about all the factors that could affect a company's future earnings. Competition regulation, technological change, consumer preferences, the overall economy. It's nearly impossible to predict all of that with perfect accuracy.
So even the experts are dealing with like incomplete information.
Right.
Which makes them more susceptible to these biases as well.
Of course.
It's like we're all trying to solve a puzzle with missing pieces.
Exactly. And that's why arbitrage in the purest sense is so challenging.
Right.
You can't definitively say a stock is overvalued or undervalued unless its price moves significantly away from any reasonable estimate of its worth.
So these self-fulfilling prophecies can run their course for quite a while before anyone steps in to say, like,
Yeah.
hold on, this is getting out of hand.
Right. And the paper actually draws a parallel to some classic research on market overreaction by economists DeBont and Thaler.
Okay?
They found that stocks that had performed exceptionally well over a period of several years tended to subsequently underperform, and vice versa.
So there is a tendency for things to revert to the mean eventually,
Right.
but on a much longer time scale than we might expect.
That's right. And that time scale, about 4 years or so, is right around when those random price fluctuations are likely to push things outside that band of rationality,
Okay.
triggering those fundamental forces of mean reversion.
Okay, so what does all of this mean for us as investors?
Right.
If we know that these self-referential dynamics are so powerful, how can we use that knowledge to maybe make better decisions?
Well, I think the first step is simply being aware of these biases.
Right.
Knowing that market sentiment can be influenced by self-fulfilling prophecies as much as by objective information can help us view things with a more critical eye.
So don't just blindly follow the herd or assume that the latest trend will continue forever.
Exactly.
Do your own research, consider multiple perspectives,
Yeah.
and try to separate those emotionally driven narratives from the underlying fundamentals.
Exactly. And remember, even though these self-referential dynamics can create distortions in the market, they're not the only forces at play.
Right.
There's still real information flowing in real companies creating value and real economic forces shaping the landscape.
It's about finding that balance, isn't it?
It is.
Acknowledging the power of these self-fulfilling prophecies, but not letting them completely cloud our judgment.
Absolutely. And perhaps the most important takeaway from all of this is that the market is a complex, adaptive system.
Right.
That's constantly evolving. There's no single model or theory that can perfectly capture all of its nuances.
Which is both exciting and a little intimidating, right?
Yeah.
It means we can't just set our portfolios on autopilot and expect everything to work out perfectly. We need to stay engaged, stay informed, and keep learning.
Couldn't agree more. And that's what makes exploring these ideas so fascinating. The more we understand about how markets really work, the better equipped we are to navigate them successfully.
Well said. I think we've given our listeners a lot to think about today. It's been a great discussion. Until next time.